That is precisely why 90% of traders are unprofitable. You must understand this. Every single high time frame's key level only works perfectly when it is properly aligned with a suitable low time frame key level. For example, if you mark a key level on a daily time frame, then by shifting to a 1-hour time frame, you will achieve a perfect entry on that level. And if you mark a significant key level on a 4-hour time frame, then by shifting down to a 15-minute time frame, we can often find a perfect entry point. So let's take an example to understand this better. For example, in this 4-hour chart, the price has performed a liquidity sweep right here. This essentially means that the price, having done this, will now target the next area of security that is resting above the swing high. For a perfect entry, we need to shift to the 15-minute time frame. And if you observe, we're getting a very clean entry model right here. Price first swept the liquidity and then it broke the market structure. After that, price created a fair value gap, retested it, and we need to make our entry right here. Stop loss below the fair value gap, and our target will be the next liquidity level. Your order block fails every single time simply because you do not follow these essential steps. Therefore, first and foremost, we must identify and mark the swing low, then patiently wait for the price to sweep its underlying liquidity. Subsequently, we must then proceed to mark the last swing high and patiently await for the price to decisively break through it. Immediately after the price successfully breaks above that swing high, the very last selling candle then becomes what we consider our truly valid order block. After locating an order block, we must also identify a fair value gap. Once the price taps both the order block and the fair value gap and then forms a strong rejection candle, there's a very high probability that price will give us a strong bullish momentum from this point. Your liquidity fails every time because you consider every swing high and every swing low as liquidity, and you expect a reversal from everywhere. So let's understand this correctly. First, you need to switch to the daily time frame and mark the high and low of the 1-day candle. Then shift to the 15-minute time frame and mark the high and low of the previous session. So you'll need to wait for the price to react once it reaches these levels. If the price aggressively rejects from these specific levels and forms an inverted fair value gap, then you can definitely expect a potential reversal trade. However, if the price aggressively breaks through these levels and creates a fair value gap, then you should plan for a continuation trade instead. If you want a detailed video on this concept, make sure to follow and then comment concept. 90% of traders simply fail to grasp this one crucial daily candle. But if you truly understand it, then no one can ever stop you from becoming profitable. Now listen very carefully. First, you need to mark the previous day's candle's high, low, and its 50% area. These three levels will define your entire trading setup and everything else will revolve around them. Now, after you have marked these levels, you should shift to the 15-minute time frame. Here, you will find your complete setup looking clean and clear. Now, when the market reaches the candle's high point, take a sell entry. Your first target will be the candle's 50% area and your second target will be the candle's low. Fourth, take a buy entry at the low. Specifically, when the market is at the candle's lowest point, that's your moment to buy. Your first target will be the candle's 50% area and your second target will be the candle's high. And when the market is within the candle's 50% area, do absolutely nothing, no trade. If you consistently practice this strategy every single day, becoming reliably profitable is merely a matter of time.